My 2024 RRSP isn't due till February 2025. Why are you talking about it so early? I'm an entrepreneur. Am I entitled to a TFSA or an RRSP? How much can I contribute to an RRSP? How much can I contribute to a TFSA? What are the tax consequences if I transfer my RRSP and TFSA to my spouse upon my death? What is this home buyer's plan all about? What is this lifelong learning plan all about? Guys, I know you have a lot of questions. I will answer them all. Plus, I want to give you some more tidbits. So since we're hanging out for a while, what I need you to do is grab a good quality pen, a paper, and some munchies, because you and I were hanging out. And listen, while we're at it, I need you to give me some SLC. SLC is subscribe, like, and comment. All right, let's get started here. Let's delve into the TFSA, a tax-free savings account. Now, from your net income, let's say you're saving $500 a month in your TFSA. The interest, the dividends, the capital gains that you earn in this TFSA program grows tax-free. The TFSA program started in 2009. If you have not put in a single dollar in your TFSA account, don't get discouraged, because the good news is you can make retroactive payments. So this is how much you could have put into your TFSA account. In 2009 to 2012, you could have made a contribution of $5,000 per year for a total of $20,000. In 2013 and 14, the amount jumped up to $5,500 a year for a total of $11,000. In 2015, under the conservative government, they cranked it up to $10,000. And then the liberals brought it back down in 2016 to $5,500. And it remained that way until 2018 for a total of $16,500. Then in 2019, they felt some pity on us and jacked it back up to $6,000 per annum up until 2022 for a total of $24,000. Then they gave us another $500 in 2023 for $6,500. And now in 2024, we were allowed to make a contribution of $7,000. So from inception till today, you could have made a total contribution of $95,000. But, in order to qualify for the TFSA program, you have to hit three criteria, and it has to be all three or nothing. Number one, you have to be 18 years old and older. Number two, you have to have a valid SIN card. Number three, you have to be a resident of Canada for tax purposes. Now, here's something really cool about the TFSA and my favorite thing about this program. Let's just assume in 2023, you hit on some rainy days and you have to pull out $5,000 as an emergency fund. Now, in 2024, what you can do, you have that $7,000 contribution room, but because you pulled out $5,000 in 23, you can now replenish that $5,000 in 2024, which means you can make a contribution of $12,000 as opposed to $7,000. So the type of investments you can own in a TFSA are the following: cash, mutual funds, securities listed on a designated stock exchange, guaranteed investment certificates, bonds, and certain shares of small business corporations. Now, in the event you over-contribute to your TFSA account, so for example, in 2024, the limit is $7,000. Let's say by mistake, you put in $8,000. You will be assessed a 1% penalty per month on the excess amount. So what that amounts to, every month, you'll be charged a penalty of $10 until you withdraw that amount. So in essence, it becomes 12% for the entire year, which is pretty significant. Another awesome fact about the TFSA program is that not only is this tax-free, but it will not affect your OAS, your old age security, or your GIS, your guaranteed income supplement. So for those individuals who are slightly low income earners in their retirement, this is just added money to help you get by. Now, if all this wasn't enough to encourage you to open up a TFSA account, here are some extra added benefits. Any growth or contribution in your TFSA account will not affect your childcare benefit, your employment insurance benefit, your Canada Workers benefit, or your sales tax credits to which you're entitled. So guys, here's my verdict. If you met the three criteria I listed earlier, SIN number, age, and residency, and you don't have a TFSA account, what are you waiting for? Find yourself a good financial planner. And I want to say one more thing. A lot of people who are not financial planners are giving a lot of stock advice on the internet. Stop listening to them. These guys are not qualified. They don't have the training, nor do they have the tools to assess market conditions the way a good, proper, qualified financial planner would. And one more thing, very important. If you are not sure how much you can contribute to your TFSA, meaning what is your retroactive amount up to date, go to your CRA website, log on, and in your profile, you can find out exactly how much room you have. Now, let's move on to the RRSP, a Registered Retirement Savings Plan. A registered retirement savings plan is very similar to the TFSA up to a certain extent. So if you invest $1,000 today in your RRSP, and next year that $1,000 you incur unrealized gains of $500, your portfolio is now valued at $1,500, you will not be taxed on that $500 unrealized gain. So up until now, we are running parallel with the TFSA program. Now, where the two programs fork and diverge are from this point forward. For the 2024 tax season, you can invest up to 18% of your gross salary or a maximum of $31,560. For example, if you earn $100,000 in gross income, the most you can put into your RSP, 18%, is $18,000. Now, if you earn $200,000, the most you can put into your RSP is not $36,000, which is $200,000 times 18%. Like I said, it's capped off at $31,560. Therefore, the most you can put in is $31,560. Now, this is where things get exciting with the RSP program. Let me give you two examples. Example one, you earn $100,000 and you make zero contributions to your RRS. Tax rate is, let's say, 30%, $30,000 in income tax. In scenario two, you earn that same $100,000, but you put your $18,000 in your RSP. So instead of being taxed on $100,000, you will be taxed on $100,000 minus the $18,000, which brings you down to $82,000. So $82,000 times 30% is a tax bill of $24,600 for a saving of $5,400. So two things have happened. A, you've put away $18,000 into your retirement nest, which is a good thing. And on top of that, today, you have saved yourself $5,400 in tax. In addition, if you have room from prior years because you didn't contribute up to the maximum amount, you can then retroactively make excess payments. Now, once again, if you're wondering, do I have room or don't have room? What's the situation? Go to the CRA website, log on to your account, and on your notice of assessment, it will tell you how much room do you have from prior years to put into your RSP. Another fundamental difference between the RSP and the TFSA program is that the RSP, like I said, will give you immediate tax benefits. All right. And then in the future, when you retire and you pull the money out of your RSP, you will be then taxed at that point in time. But in theory, when you retire, your income should be less than what you earn today. Therefore, in theory, you should be in a lower tax bracket, meaning you have saved on tax once again. So those are 3 times when you end up saving on taxes. Now, another thing to note that is fundamentally different between the RRSP and the TFSA is that the TFSA account can be used for a rainy day. There is no tax consequences to you when you pull the money out. However, in the RRSP program, the thought process is this money will be used upon your retirement. It is not to be used as a rainy day bucket. Now, in order to contribute to your RRSP program, you have to be on a Canadian payroll. And number 2, you can only contribute to the RRSP program up until the age of 71. So if you're 72 years old, you're still employed, and you're earning a T4, you are no longer allowed to make an RRSP contribution. And something else I want to tell you. If you have a company-sponsored pension plan, meaning if your employer is making contributions to your pension plan, that amount plus any amount you are putting into that company plan will be deducted from your 18% or $31,000 threshold, meaning it is part and parcel of your total contribution. You cannot go above that just because you have a company pension plan. A key word that I used earlier is if you're receiving a T4. A lot of Canadian entrepreneurs out there are being paid through dividends. If the entrepreneur is paying themselves with a dividend, they do not qualify for the RRSP program, but they do qualify for the TFSA program. Another similarity you might want to jot down on that pad of yours is in the event that you make excess contributions to your RRSP, it will be taxed at a 1% penalty, just like the TFSA program. One caveat for the RRSP program is it allows you a lifetime over-contribution limit of $2,000. Meaning, if you're allowed to put $9,000 into your RRSP based off the 18% calculation, but by mistake you end up putting $11,000, you will not be penalized. There's no penalty at all. And that $2,000 excess cannot be used to deduct your income. Your income will be reduced by the $9,000, which is the allotted amount. All right, guys, now let's quickly jump into the HBP. The HBP stands for the Home Buyers Plan. And what the Home Buyers Plan is basically a branch breaks off of the RRSP and goes into its own little separate program. Now, in 2024, the Home Buyer Plan limit jumped from $35,000 to $60,000. And the way it works is when you go buy that first home of yours, you will pull out that $60,000. Now, in an RSP program, traditional RSP, when you pull out that $60,000, it's taxed immediately. So let's say if you're earning $100,000, you'll now be taxed on $160,000. But in this case, that $60,000 withdrawal from the RRSP is not taxed if that money goes directly into that new home that you're purchasing. And the only rule they have around this program is that the home, the property, has to be purchased in Canada. It cannot be outside the country. Now, for the next 5 years, let's say you purchase your home in 2024. For the next 5 years, there is a grace period, meaning you don't have to replenish that $60,000 you had pulled out. But starting year 5, you now have 15 years to replenish that $60,000 you had taken. And it has to be done over a straight line. Now, your contributions can be greater than the allotted annual amount in the event that you don't make any contributions to replenish that amount that you pulled out of the program. The amount will be added to your income. For example, if you pulled out $60,000 and this amounts to $4,000 a year or $333.33 a month. Now, if you don't put back that $4,000, your $100,000 of gross income will now be taxed at 104 instead of the 100. There is also a very similar program called the Lifelong Learning Program, LLLP. And what this is, it's a twin sister of the HBP. What this is you can withdraw up to $10,000 per year from your RRSP account up to a maximum of $20,000 over 4 years for a accredited course in Canada. Now, another benefit of this program is if you are going to, let's say, university to get a degree, you can pull this money out of your spouse's RRSP account and use it towards your education. However, you cannot pull the money out of your RRSP or your spouse's RRSP and fund your children's education. That is not allowed. Now, how do you pay back this amount? From the date of your first withdrawal, you have 4 years grace period. So after that 4-year grace period, you make those payments over 10 years, amortized. And like I said, the amortized amount is a minimum. If you want to make more excess contributions, incremental contributions, you're allowed to do so. And if you fall below the amortized allotted amount, you will then have to pay the shortfall as tax on your T1, which is your income tax return. Now, whether it's the home buyer's plan or the lifelong learning plan, in the event that you become a non-citizen or in the event that you pass away, the entire outstanding amount has to be replenished. If not, it will be added on to your estate tax as income. As for your home that you purchased, in the event that you sell that first home of yours, from the proceeds of your sale of the house, you have to replenish that home buyer's plan in whole. If not, you can probably assume what's going to happen. That outstanding amount, the total amount, will be added to your income. Now, for all my entrepreneurs out there, a corporation cannot have a TFSA or an RRSP residing within the corporation. What a corporation can have is an employer-sponsored pension plan. Meaning, if you have staff, you can open up a pension plan within the corporation that will make contributions towards your employees' pension. The contribution that the employer makes is a tax deduction. It's an expense for the employer. And the money that the employee is receiving, whether you're the owner of the company or an employee, will be considered a benefit which is taxable. Meaning, if I own a company and I put $5,000 in my employee's pension plan, or I put $5,000 in my employee's TFSA account, the employee has received a taxable benefit of $5,000, and I have a tax deduction on my corporate income tax of $5,000. Now, this is the part where I will vent. A lot of entrepreneurs pay themselves in dividends, and this is the worst decision they can possibly make as an entrepreneur. What's even more disturbing is that accountants are not even advising them, and shame on them for allowing this to happen. The dividend compensation is to be used in specific situations under very specific tax strategies. And unfortunately, that is not the case. RRSP and CPP are wonderful tools, not only for building retirement nests, as you've probably realized, but also for estate planning. All the funds in your RRSP get transferred to your spouse tax-free at the time of death. Receiving a T4 through your corporation makes it easier for you to get a loan in the event you want to buy a residential property or even an investment property outside the corporation. An entrepreneur who pays themselves via dividends can only save their cash in non-registered accounts. Now non-registered funds, the downside to it is that every year you have to pay taxes on the gains, whether you realize them or not. And yes, an entrepreneur who pays themselves via dividends can open a TFSA account, which is a win. However, think about it. All you can put in your TFSA account for 2024 is $7,000. Since its inception, it's a total of $95,000. So my request to you is to please take care of your financial situation. Take advantage of all the tools that are at your disposal. Do the analysis. Figure out which tax strategy and which tool works in your favor. And remember, it all starts with a simple conversation.